Welcome back, everybody, to part 2 of 3 of my series where we look at the 30 stocks of the Dow Jones Industrial Average. If you did miss the first video, there should be a link in the top right-hand corner of this video appearing that'll send you over to that video, so check it out when you're done with this one. Now, that video did go on for a little bit longer than I had hoped, so I'm going to try and make this one a lot quicker. So we're just going to jump right into this, starting with Goldman Sachs, ticker symbol GS. This is an investment banking company with current market cap of $197 billion. Goldman's price to sales is currently at 4.02, which is about double what its long-term average is, representing a 72% premium to its average. Its PE ratio is 17.6, which is also much higher than its 5-year average of 10.36, although the last 5 years have been difficult for banking stocks in general, so that might be a lower average than normal. Anything using EBITDA is just not going to work. These large banks and their EBITDA numbers just don't really work well, so I'm just going to ignore that. Moving on to price to EBIT, again, we see a large overvaluation, 68% in this case. And with the way these large banks work, again, free cash flow can be quite difficult for accounting reasons, so we're going to ignore anything that uses free cash flow as well. Book value and tangible book value are very important for banks, though, and we can see that Goldman Sachs is about 68% overvalued on a book value basis, and again, 68% overvalued on a tangible book basis, usually trading around 1 to 1.2 times, but currently around 2 times its book value. Its current dividend yield is 1.88%, which is 23% lower than the long-term average of 2.45%. And if we take a look at the long-term drawdown chart, we can see that Goldman Sachs is down about 1.46% off of its all-time high, essentially trading at the highest prices it's ever been at. But we can see that this company regularly draws down 30%, sometimes close to 50%. And then finally, taking a look at our X factors, we can see a huge expected 5-year earnings growth of 18.87% for Goldman Sachs and a price to earnings growth plus yield of 0.85, which is really good. With the final factor, enterprise value to free cash flow, we're going to ignore that because with the math on how enterprise value calculates in these large banks as well as free cash flow, it's basically irrelevant. But going back to this PEGI ratio, I mean, that is quite solid and I think the best that we've seen so far. Our second stock for the day is Home Depot, ticker symbol HD, which is a home improvement retail company with a current market cap of $428.5 billion. Home Depot is currently trading at a 31% premium to its average price to sales, which over the last 5 years has been 2.1 and is currently at 2.76. The company also trades at a 41% premium to its long-term price to earnings average of 21 approximately. It's currently trading at 29, which is especially interesting considering analysts expect the next couple of years to have pretty flat earnings growth. Price to EBITDA does not look much better at a 35% premium, and price to EBIT is at about a 38% premium. On a free cash flow basis, Home Depot looks slightly less overvalued, but still about 30% overvalued. Book and tangible book values are not very useful for this company, so we'll move on and take a look at the dividend yield, which is currently about a 17.5% premium at about 2.09% for the current yield versus a 5-year average of 2.5%. And like many of the other ratios, Home Depot's enterprise value to EBITDA numbers are about 35% overvalued. Free cash flow again is slightly better, but again, 29% overvalued. And when we take a look at the company's drawdown chart, we can see that it is currently at all-time highs with a 0% drawdown. And what's interesting is that although Home Depot is capable of very large 30 to 40% drawdowns, as it's shown in the last 10 years, it also can go for very long stretches where its max drawdown is only about 10-15%. So it's generally been quite a stable stock. And then finally, taking a look at our X factors, the company is expected to grow at 4.28% per year for the next 5 years, which is positive, but not very fast, especially compared to other companies we've looked at. And the company's PEGI ratio is 4.6, with its EV to free cash flow over growth and yield ratio of 6.5. Neither of these numbers are very good at all, and we've certainly seen much more attractive companies, both in this video and the previous one. Up next is Honeywell International, ticker symbol HON, which is an industrial conglomerate company with a market cap of $147.2 billion. Honeywell trades at a slight premium of about 6.5% to its long-term price to sales numbers, and it trades at a slight 8% premium to its long-term PE average, although analyst estimates do expect this company to earn quite a bit in the next few years, so this is fully justified. Price to EBITDA is about a 5% premium, which again is basically fair value, and price to EBIT is about a 5.2% premium. The company's free cash flow generation has struggled a little bit in recent years, leading to a premium of about 32%, but should that recover to normal levels, it's basically trading at fair value again. Using book value, we can see that Honeywell's trading at about a 15% premium, and when we take a look at tangible book value, we aren't really able to gain much because it's generally a negative number. On a dividend yield basis, the company's about 7% overvalued with a current yield of 1.91%, and its current enterprise value to EBITDA number of 17.17 is about 5% over its long-term average of 16.4. Once again, enterprise value to free cash flow looks much more overvalued, but we can expect that number to improve as long as the company is able to get back to its previous free cash flow generation. When analyzing Honeywell's drawdown chart, we can see it's almost at all-time highs at current drawdown of 3.17%, and it's recently recovering from a pretty prolonged 20 to 30% drawdown, which for this company is generally unusual. It's only happened one other time outside of COVID, so we can see that Honeywell is, again, a quite stable company. And finally, taking a look at the X factors, this company is expected to grow at 7.86% per year for the next 5 years, which is pretty solid, especially for a large industrial company. Its PEGI ratio is 2.5, which is not great. It's certainly better than some companies, but not as good as others. And when we take a look at this number versus enterprise value and free cash flow, it is much higher, but again, that's because free cash flow has been significantly drawn down over the last couple years, and this number would improve pretty close to that 2.7-ish range if the free cash flow generation were to come back in the next year or two. Fourth on our list is International Business Machines, better known as IBM, with the ticker symbol IBM, of course. This company is in the IT consulting sector and it has a current market cap of $220 billion. IBM has quite slow growing sales and is currently priced at nearly a 70% premium to its long-term price to sales average of 2. The company is priced at a 22% premium to its earnings per share, although those numbers are expected to be quite high in the next couple of years, according to analysts, so this might be justified. IBM trades at a 36% premium to its long-term price to EBITDA numbers, although I think it's fair to point out that its average price to EBITDA is 11, which is quite low, especially for a technology company, so it might be returning to a more fair number at currently 15. Price to EBIT shows a 19% discount to its long-term average, although EBIT for IBM has been quite variable, so this number is a little less reliable. And the company trades at a 21 times price to free cash flow, which represents a 45% premium to its long-term average. Although again, this is a little bit more normal for companies in the technology sector, so this may be returning to a more industry average. Based on price to book, IBM is trading at a 56% premium, and its long-term tangible book average is negative, so it's not very helpful. What is quite interesting is that the company currently yields 2.8%, which is a 43% premium to its long-term average of 4.9%. Although again, this might be returning to more of an industry average, as 4.9% is quite high for a tech company. Enterprise value to EBITDA is currently at a 21.5% premium, and enterprise value to free cash flow is at a 30% premium. And when we take a look at the drawdown chart, we see something really interesting with IBM, and that is that 1, the company is at all-time highs, and 2, it spent most of the last 10 years in a huge drawdown, at its maximum point reaching about 50% from all-time highs, lasting nearly 10 years. When we take a final look at the company's X factors, we can see an expected growth of 4.4% in earnings for the next 5 years, a PE over growth plus yield ratio of 4.82, which is quite high, and an enterprise value to free cash flow over growth and yield of 3.56, which again is quite high. So in many ways, IBM does look overpriced at this current junction, but you could also make the argument that the last 5 years aren't very indicative of where the company should have been traded. Halfway through our list, and we are on Johnson & Johnson, the pharmaceuticals giant, ticker symbol J&J, which has a current market cap of $359.5 billion. J&J currently trades at a 16.5% discount to its long-term average price to sales, and an 11% premium to its earnings per share, although with its earnings per share expected to increase in the future, this does represent probably a long-term discount. The company's price to EBITDA is at a 15% discount to its long-term average, currently trading at about 12, and its price to EBIT is at a 16% discount. Looking at free cash flow, the numbers get even better at about a 17% discount for Johnson & Johnson. It trades at a 12% discount in price to book, and its price to tangible book value has been negative, so not very useful for us in these circumstances. J&J's current yield of 3.25% represents a nearly 18% discount to its long-term average of 2.76%. Its enterprise value to EBITDA is about a 12% discount, and its enterprise value to free cash flow is about a 14.5% discount. And taking a look at Johnson & Johnson's drawdown chart, we can see it's in the middle of one of the worst drawdowns it's experienced in the last 10 years, eclipsed only by the COVID drawdown, which occurred in 2020, of course. And finally, taking a look at the X factors, Johnson & Johnson is expected to grow at 5.2% per year for the next 5 years, leading to a PEGI ratio of just under 3 and an EV over free cash flow to growth plus yield ratio of 2.23. Now, neither of these two numbers are super impressive, but with Johnson & Johnson, it is an incredibly safe company. It's one of 2 AAA rated companies in the world, so it does generally trade at a little bit of a premium on its long-term growth prospects. Number 6 on our list is everybody's favorite too big to fail bank. That is JPMorgan Chase, of course, ticker symbol JPM, with a market cap of just under $700 billion. JPMorgan trades at a current 35% premium to its long-term price to sales ratio, and again about a 31% premium to its long-term price to earnings ratio, which averages 10.5 but is currently at 13.77. Another interesting thing to point out is that analysts expect this company's earnings per shares to actually dip over the next year or two. We're going to skip anything related to EBITDA because it just doesn't really work with big banks. But on an EBIT basis, again, we see this overvaluation, 28% overvalued on price to EBIT. JP Morgan's free cash flow is also super variable. So again, not really a great metric for us to use to value this company. But with banks, book value is a very, very important metric. And here we see that JP Morgan is trading at nearly a 43% premium to its long-term average price to book of 1.5. Price to tangible book looks ugly as well, trading again at a 39% premium. And to top it off, the company's trading at a 36% premium to its long-term average dividend yield of 2.91%. Whereas it's currently yielding 1.86%. JP Morgan, being the largest and one of the most stable banks in the US banking system, means that there's not a huge number of large drawdowns for this company, but we did see on a couple occasions recently 40% drawdowns for JP Morgan, first due to COVID and second due to raising interest rates. But even with all that negative price action, the company is basically at all-time highs, currently showing a 1% drawdown. And finally, taking a look at the X factors, we see that JP Morgan is expected to grow 1.67% per year for the next 5 years, which is pretty abysmal. I mean, at least it's positive, but it's very slow. And our PEGI ratio shows 3.9, which again is towards the higher end of what we've seen for other companies. And as one last note, enterprise value is not very useful for large banks, so this EV free cash flow to growth plus yield ratio is basically useless. Up next is the soft drink giant Coca Cola company, ticker symbol KO, with a market cap of $269 billion. Coca Cola trades at a slight 3.5% discount to its long-term average price to sales, which currently hovers at 5.82 versus an average of 6. Coke's earnings per share is at a 0.33% premium, basically trading perfectly at fair value, although analysts do expect a small jump in earnings over the next few years, so this might be a discount in the long term. Based on price to EBITDA, Coke is at a 2% discount. Again, basically fair value, and comparing the price to EBIT ratio, it trades at a 5% discount. Using free cash flow, we see that Coke is trading at a 43% discount, although I will say this is due to a huge spike in free cash flow for this year's numbers, so I would caution that and probably look into why the free cash flow has jumped so much this year. I would not expect it to be that high next year. Based on price to book, Coke is trading at a 5% discount, and its tangible book value has been negative for all 5 years, so this number is not useful for us. Taking a look at the company's dividend yield, it trades at a 0.85% premium to its long-term average, again, basically at fair value, with a current yield of 3.07% versus a 3.1% long-term average. EV to EBITDA, same story, about a 2% discount, basically at fair value. EV to free cash flow, again, shows a huge discount because of the high free cash flow numbers this year. I would take that with a grain of salt. Coca Cola quite regularly draws down about 10 to 15%, but very rarely draws down further than that. With its current stock drawdown at 13.72%, we're looking at a potentially quite decent time to buy the company. The only time it's had a drawdown any larger than that in the last 10 years was during the COVID panic, where the company drew down about 35%. And then finally, for our X factors, Coca Cola is expected to grow at 5.33% per year, which is not bad for a company that size. Its PEGI ratio is 3.1, again, not terrible, especially for Coca Cola, which is considered a very safe company. And its EV to free cash flow ratio of 2.53, again, is probably a little bit low due to the fact that free cash flow is so high this year. Should probably be closer to 3, but again, not terrible for such a safe company. Stock number 8 on today's video is the McDonald's Corporation, ticker symbol MCD, which we all know is a fast food restaurant with a current market cap of $214.25 billion. The company currently trades at an 8% premium to its price to sales average and a small 1 2/3% discount to its long-term earnings per share average, which is currently hovering at 26.25. Price to EBITDA trades at a 4% premium, and McDonald's price to EBIT trades at about a 2.5% premium. Free cash flow numbers look the best though, with a current discount of 7.5%, which is again basically confirming that McDonald's is trading at a very fair value right now. Both the company's book value and tangible book value are negative, so they are quite useless for us here. The company's current dividend yield of 2.23% represents a 4.5% premium to its long-term average dividend yield. Its enterprise value to EBITDA is at a 5% premium, and its enterprise value to free cash flow is about a 6.5% discount. And taking a look at the drawdown chart, we can see that McDonald's is one of the most stable stocks in the market, hardly ever drawing down more than 15%. Its current drawdown is about 5%, and it can go long stretches without drawing down more than 1 or 2%, so now might be a decent time to check out McDonald's given its fair value. The company is expected to grow at 5.89% per year for the next 5 years. Its current PEGI ratio is 3.23, which is on the high side, and its EV to free cash flow over growth and yield is at 4.5, which again is also on the high side. But McDonald's is considered quite safe and hardly ever trades at these ratios below like a 3. Our second to last company for the video today is the somewhat troubled 3M company, ticker symbol MMM, which is an industrial conglomerate with a current market cap of about $72.5 billion. 3M currently trades at a 5% premium to its long-term price to sales average. And according to this chart, it's at about a 52% premium to its PE long-term average, although I will say that the average is currently at 11 due to the absolutely terrible 2023 that the company had. And this number should be closer to 15 or 16 probably. So the company does trade at a premium. It's just a much smaller premium than suggested by this chart. That is further backed up by the price to EBITDA, which trades at about an 8% premium, and price to EBIT, which trades at about a 6% premium. 3M's free cash flow has been quite variable for a number of reasons. Currently trades at a 52% premium to its free cash flow numbers, but take this premium with a grain of salt as well. What is interesting is the absolute plummeting of the company's book value, although the premium of 106% again is probably over-exaggerating the premium that this company trades at. Tangible book for 3M has been negative, so it's quite a useless chart here. But what is quite interesting is that the company trades at a 31% premium to its long-term dividend yield average of 4.82% versus its current yield of 3.31%. Enterprise value to EBITDA is at a 5.5% premium, and again, due to variable free cash flow numbers, we see a 50% premium for EV to free cash flow. But what is most interesting about this company is the 10-year drawdown chart, where we can see that the company has not made a new all-time high since 2018 and has been in the middle of a massive drawdown, at one point reaching nearly 70% down. And finally, taking a look at the X factors, we do have our very first negative growth company. 3M is expected to have its earnings contract by about 2% per year for the next 5 years. And this leads to some pretty ugly ratios. Its PEGI ratio is 12.42. Its EV to free cash flow ratio is 18.66. So in general, this company does not look like a very good investment today. And our final company for the video is MRK, that is Merck & Company, which is a pharmaceutical company with a current market cap of $261 billion. Merck currently trades at about an 8.35% discount to its long-term price to sales average. And take my word for it, the company is currently trading around fair value for its price to earnings. This number is very heavily skewed by 2023, in which the company had very low earnings. Just a one-off situation, which has skewed the entire average price to earnings ratio for the 5 years. On a price to EBITDA basis, Merck is trading at 11.5% discount, currently at 11.43 versus its long-term average of about 13. On an EBIT basis, the company looks even better at a 14% discount. And using free cash flow, Merck is trading at a discount of 36%, although its free cash flow does fluctuate quite significantly, so this is a little less reliable. Once again, we see that Merck is trading at a discount when we look at price to book value with a current discount of 11.3%. The company's tangible book value average over the last 5 years is negative though, so this is quite unhelpful for our graph. Taking a look at dividend yield, the company is basically at fair value with a 0.64% premium, trading with a current yield of 2.95% versus a 5-year average of 2.97%. Enterprise value to EBITDA shows a discount of 12.5%, and EV to free cash flow shows a discount of 37%, although again, this is skewed by the very high free cash flow numbers this year. And what's really interesting is that Merck is in the midst of its largest drawdown in the last 10 years, reaching a maximum of about 26% drawn down and currently sitting at about 22% down from all-time highs. This eclipses even the company's COVID drawdown, which was about 21 or 22%. And finally, let's take a look at the X factors, which are absolutely incredible for Merck in this case. The company is expected to grow by more than 40% per year for the next 5 years, which I will say, please take that with a grain of salt. That seems highly unrealistic given the company's growth rate over the long term, but it does signify that there is some very high potential growth ahead. This leads to a PEGI ratio of 0.5 and an EV free cash flow over growth and yield ratio of 0.47, both of which are excellent and denote what could be a very good buying opportunity for this company. So those are the next 10 Dow Industrial stocks. Once again, if you missed the first video, please go back and check that out to see the first 10. But before you do that, please like this video and leave a comment down below, letting me know if you'd like to see any other stocks, whether in this video, in other videos, or just on your watch list, analyzed. As always, thank you so much for spending your time here, and I can't wait to see you guys in the next one.